What if you only get one chance to decide how to take your pension? If I could show you how this one choice shapes your entire retirement story, would you make it with intention instead of guessing?
Pensions often get put on a pedestal. People assume that lifetime income means no worries. But the truth is, they come with risk. A lot can go wrong if you don't understand four critical factors that can turn what seems like your safety net into a potential financial trap that could limit your options for what could be decades. And here's what makes this especially critical. Pension decisions are often permanent, so it's important to carefully evaluate your options. If you or your spouse has a pension or you're helping to guide decisions for your household, this important video is for you. If we haven't been introduced, my name is Marcus Griffin, and I am a wealth advisor and the founder of Narrowgate Wealth Management. And I'm on a mission to help educate and empower women and their families to make financial decisions with clarity, care, and confidence. And here's what I want to help you understand today. Your pension is not just another source of retirement money. It's actually an influential asset in your entire retirement plan. The decisions that you make around it may shape other financial choices for the next 20 or 30 years. While pension decisions are genuinely complex, they become manageable when you understand four critical factors that we will discuss. I believe a lot of retirement advice misses how pension decisions should work for someone with significant savings. The strategies that make sense when you have over $1 million in retirement savings can be completely different from generic advice. By the end of this video, I hope that you will have a clear framework for evaluating these decisions, whether you're making them for yourself or for your family. Now, let me help guide you through the four critical factors that will help determine if your pension becomes a cornerstone for your retirement security or a decision that you may later regret. And these aren't just technical details. These are the foundation for other financial decisions that you will make in retirement. And because these decisions are generally permanent, understanding them thoroughly before you choose is essential. Factor 1, the lump sum versus monthly payment decision. Let's start with a big one, the decision that changes the other three factors. But first, congratulations if either you or your spouse has a pension. It means that you have something valuable. A company or organization that is committed to making sure you have regular monthly payments throughout retirement. The reliability of these payments depends on your specific plan type, your funding status, and legal protections. Only about 1 in 4 workers have pension benefits today. But with that benefit comes a choice that can't be changed. So here's what this looks like with real but hypothetical numbers. Let's say you're looking at these three options. Take $2,800 per month for life, but only as long as you live. Take $2,350 per month, but it continues for your spouse if you pass away first. Or take $500,000 as a one-time payment, often called a lump sum payment, and then walk away. Here's what most people don't realize. This isn't just about what number looks bigger. This decision determines how much risk you'll carry with the rest of your money, how aggressive you can be with your other investments, and how much you'll need to withdraw from your retirement accounts. If you have substantial savings, let's say over $1 million across your retirement and other accounts, taking the lump sum might make sense because you can afford to take on the investment risk. But if that pension represents a significant portion of your retirement security, walking away from guaranteed payments could force you to be much more conservative with everything else. The potential trap happens because people assume that the lump sum is always better because it sounds more flexible. But you need to know, companies often have a financial incentive to offer you that lump sum payment rather than continue to make monthly payments for 20 or 30 years. So while that lump sum number might look attractive, in some circumstances, guaranteed monthly payments may provide more stability or predictability depending on your situation. Factor 2, the inflation reality. This is the silent, invisible threat that poses a risk that can significantly decrease the value of pension income over time. Most pensions give you the same dollar amount every month for life. So, if you're getting $2,800 per month now, you'll be getting $2,800 per month 20 years from now. But here's the problem. That $2,800 now, based on history, won't provide $2,800 of goods and services 2 decades from now. With just 2.6% inflation, which is the average since 1990, your pension would lose about 40% of its purchasing power over 20 years. So think about it this way. If you retire at 62, by the time you're 82, if inflation averages 2.6% per year, that $2,800 pension payment will only buy about $1,675 worth of what it will buy today. And healthcare costs, which often hit retirees the hardest, often inflate much faster than general inflation. Some pensions do include cost of living adjustments, often called COLA or COLA, but many don't, especially in the private sector. This is where having other money becomes crucial. If you have that $1 million or more in retirement accounts, you can choose to invest more aggressively to specifically fight inflation. But it is also important to understand that comes with risk and there are no guarantees. Think of your pension as the steady, predictable part of your income and your other investments as your way of managing the risk of inflation. This may change how you should think about your investment mix compared to someone who doesn't have guaranteed pension income. Factor 3, survivor benefit optimization. This is where pension decisions get really personal and where some people make what could be viewed as costly mistakes. Let's go back to those numbers that I showed you earlier. Remember, you could take $2,800 per month for your life only, and when you, as the pension owner, passes away, the benefit goes away. Or if you choose for your spouse to continue with benefits if you pass away, the company may pay about $2,350 per month, but that is for both of your lifetimes. That difference, $450 per month, is essentially what you're paying for spouse insurance. Over 20 years, that is $108,000 you're giving up to help protect your spouse. Now here's the question you need to ask. Could you provide better protection for your spouse with that $108,000? Maybe you take the higher pension and use some of the excess money to fund further retirement savings. Maybe you purchase life insurance. Maybe you do more Roth conversions that create tax-free inheritance. And this gets especially complex when there's an age difference between the spouses. If one spouse is significantly younger, then that survivor benefit becomes extremely valuable because it could last for decades. But if the pension holder is the younger spouse with better health, paying for the survivor benefit might not make financial sense. And here's something people often don't think about. When one spouse passes away, the surviving spouse faces a potential double hit. First, they lose one Social Security payment. And second, they now have to file taxes as a single person, which may push them into a higher tax bracket. Thus, the analysis of this third factor needs to account for spouses' ages, health, and other financial resources. Factor 4, tax coordination planning. This might be the most misunderstood aspect of pension planning. Most people assume that they will be in a lower tax bracket during retirement. But when you have a pension, Social Security, and the requirement to take money from your retirement account starting at age 73, you might actually face higher taxes than you expected. And here's the opportunity that many people miss. If you're taking pension income, you might not need to withdraw as much from your 401k or IRA during the early part of retirement. So this creates a window for Roth conversions, moving money from your traditional retirement accounts into Roth IRAs where they can grow tax-free forever. You'll pay taxes on the conversion now, but at potentially lower rates than when you are forced to take larger withdrawals from your retirement later on. This strategy may work especially well for people with substantial retirement savings because the pension income gives you flexibility about when and how much you will withdraw from your other accounts. And plus, if you're thinking about leaving money for family, Roth accounts are much better for inheritance than traditional retirement accounts because the taxes have already been paid on the money that is in those accounts. The key is coordinating your pension with Social Security claiming and your overall tax strategy. This isn't something for you to figure out in isolation because all these factors work together. Which one of these four factors is new to you? Let us know in the comments if there's anything that surprised you. So how do you actually make these decisions? Let's walk through the three-phase comprehensive framework that I use with clients. Phase 1, information gathering. Before making any pension decision, you need complete information about your specific plan. Here are the 5 essential questions that must get answered. 1. What are your exact payout options? You need specific dollar amounts for single recipient, joint survivor at different percentage payouts, and any lump sum benefit options. Number 2. Does your pension include any cost of living adjustments? This makes a huge difference in long-term value and evaluating any lump sum offers. 3. How much less money would you receive each month to ensure that your spouse continues receiving benefits? For example, if your single life pension will pay $2,800 per month, will the joint option pay $2,350, $2,500, or $2,650? You need to know the exact numbers. 4. Is your pension covered by what is called PBGC insurance? PBGC stands for Pension Benefit Guaranty Corporation, a federal agency that provides insurance protection for many private company pensions. If your plan is covered and the employer can't meet its obligations, PBGC may step in and pay benefits up to limits set by law. These limits vary based on the year of plan termination and the retiree's age. For example, in 2025, the maximum guaranteed benefit is $7,432 for someone age 65 as a single life annuity. If your pension isn't covered by PBGC, which is often the case with government plans, churches, or small companies, you need to understand what protection you do have, if any. Government pensions typically have different protection through state or federal backing, but you need to understand the specifics of your situation. And lastly, can you start taking your pension before normal retirement age? And if so, how much less would you receive? For example, if at age 65 your full pension is $2,800 per month, how much would you receive at 60 or 62? And unlike Social Security, most pensions don't grow if you wait beyond retirement age. So if you're eligible for full pension at 65, then waiting until 67 often won't provide you any additional benefit. Phase 2, scenario analysis. You need to model multiple scenarios because pension decisions are permanent. Here's the framework for thinking through your specific situation. Health and longevity assessment. What's your health? What's your spouse's health? What's your family's health history? If one of you has significant health concerns, then that likely changes the math completely. Financial security analysis. What other assets do you have? What are your income sources? What are your spending needs? The more you have in other retirement accounts and savings, the more flexibility you have with your pension decision. Tax coordination. What are your current and projected tax brackets? Are you considering moving to a different state? Some states don't tax pension income. Inflation protection. How will you maintain purchasing power over 20 to 30 years if your income is fixed? Survivor protection. What happens to the surviving spouse? Remember, they'll lose one Social Security payment and may face a higher tax bracket. Phase 3, stress testing. Test your decision against worst-case scenarios and figure out how this might affect you. What if one of you passes away earlier than expected? What if there's a market crash early in retirement? What if inflation runs higher than historical averages? Now, let's circle back on one of the biggest decisions that you must make. The decision between taking a one-time lump sum payment or receiving monthly income distributions. Here's when the lump sum payment may be optimal. If you have substantial assets, think $1 to $2 million or more across diversified accounts like retirement accounts, Roth accounts, regular brokerage accounts, and your expenses are well within your income capabilities, you can generally afford to take on investment risk. You might also consider the lump sum if you have strong investment experience, or shorter life expectancy due to health issues, or your spouse has independent financial security. And here's where monthly payments may be optimal. For most people, the monthly income payments provide something that can't be replicated. Guaranteed income that reduces how much you need to withdraw from other accounts and provides psychological security. Monthly pension payments make sense if your retirement security is based on your pension payments, or you have limited other sources of guaranteed income, or you're concerned about market volatility, or your spouse needs income protection, or your health suggests above average longevity. I want to make sure that I'm clear about something. This is genuinely complex and the stakes are high. These decisions can't be unwound, and they'll potentially affect you for decades. Now, if you've been feeling overwhelmed by these decisions, that's completely understandable. While this is complex, it is manageable if you have the right framework and information. What's your biggest concern about making these pension decisions? Are you worried about leaving money on the table? Or are you more concerned about protecting your spouse? Or is it something else entirely? Please share in the comments because your questions help us decide what we should cover in future videos. Let's quickly recap what we've covered today. Your pension decisions may influence other aspects of your retirement planning. The four critical factors are the permanent decision between a lump sum payout or monthly distributions, protecting against inflation, optimizing survivor benefits, and coordinating your tax strategy. So these aren't just financial decisions. These are life decisions that require critical analysis of your specific situation. But when you understand these factors and use a systematic approach to explore your options, you can make decisions with increased confidence. If you're looking for guidance and education regarding your complete personal retirement situation, please look in the description below and see the link to schedule your free 30-minute discussion. As I said earlier, my mission is to educate and empower women and their loved ones to make financial decisions based on clarity, care, and confidence. And you have the ability to help others who need this information without it costing you anything. If this video helped clarify your thinking around pension decisions and retirement planning, please share it with someone else who may benefit from it. And if you'll give us a thumbs up or leave a comment, it'll help us reach other women who are also facing similar decisions. I appreciate you, and I'll see you soon.